Welcome back, everybody. Lululemon reported earnings on Wednesday, and after weeks of negative news and interviews saying that they were losing market share, we found out that, well, at least for now, they're still doing pretty well, which means that for the time being, they've kept the wide leg pants phenomenon at bay.
Okay, so wide leg bottoms, can't you just make wide leg pants?
So in this video, we're going to break down Lululemon's earnings report, see what it's meant for their stock price, and then talk about their growth outlook going forward. Let's go ahead and get started. So after weeks of negative articles, the headlines today read, Lululemon delivers strong Q1 and hikes profit guidance above street view. And that's because Lulu reported revenue and earnings per share above Wall Street analysts' estimates, and right at or above their own guidance, with revenue at $2.2 billion, which was right at the top of their own guidance and a 10% increase from the year before, as well as earnings per share of $2.54, which was above their $2.40 guidance and also an 11% increase from the year before. Now, Lulu also reaffirmed their full-year guidance for revenue and slightly increased their full-year guidance for earnings per share from a range of $14 to $14.20 to a range of $14.27 to $14.47. They also announced that they bought back $300 million worth of shares in Q1, plus authorized another $1 billion in buybacks for a total of $1.7 billion left to buy back shares, which I really hope they did during May when it was around $300 a share or even lower, but we'll have to wait till next quarter to find that out. In terms of the market reaction, initially in after-hours trading, it got up to about a 13% gain, but then came down quite a bit when the trading day opened. Now, as of this recording, Lulu is up about 5%, so we'll see where it goes from here. But let's listen to the initial reaction on CNBC after earnings were announced.
Lululemon up almost 11% in overtime after beating on both lines. CEO Calvin McDonald speaking to our Sarah Eisen moments ago, telling her the growth of the company continues to be very strong, and they saw incredible momentum in every international market. Also saying store traffic was positive, but the consumer environment remains dynamic, and inflation and higher rates are weighing on the minds of consumers. Joining us now ahead of the earnings call is Dana Telsey, CEO of Telsey Advisory Group. Dana, welcome. And maybe you can help us with this mystery. Maybe Morgan got to the bottom of it, but it didn't look like the guide was that strong compared to expectations, but the stock is higher. Is this a story of stronger margins heartening investors, or maybe that the stock has been down so much that expectations were really low?
I think the stock was down so much. You have a company that was down 35% in their stock price year to date. Here you came out and you just raised the guidance for the year. You beat, frankly, your sales came in line with expectations, if not a touch better. You look at the gross margin that came in better than expected. Basically, that gross margin was up 20 basis points and the guidance was for flat. And you look at the operating margin, the same thing. The operating margin was down 60 basis points with the guidance of down 130 to 140. And your inventories were clean too. So you talk about navigating the environment with agility in a category where they're driving more innovation, and you add to your share repurchase program, basically shows you where they believe that the strength of their brand with their innovative product can continue to drive the demand, and they'll navigate the U.S. while having growth overseas.
And in general, I agree with her take here. The host was questioning why they were up so much in after-hours trading when the beat wasn't really substantial, but I think he kind of missed the point, because this was a company that was down from $500 a share to $300 a share since the beginning of the year, with basically just a slightly softer than expected guidance in their last earnings call, and a few articles talking about how they're losing market share without really any info to back it up. So by the time earnings were reported, Lulu was a company with a revenue growth outlook of 10%, an earnings per share growth outlook of over 15%, zero net debt, and trading at a price to cash flow of under 17, which hadn't happened for them since around the time of the 2008 recession. So at that point, the only real questions you have to ask yourself are, do you think the company guidance is more accurate than the analyst predictions? And I made a whole video about this last year on the importance of judging a company based on the expectations that they give us and not what analysts think. But what I like to do in these situations is go back in history to see how well the management team has provided and executed on their guidance. And so for Lulu, I went back over the last couple years of quarterly reports and tracked their guidance versus how they performed. And Here's what I found. Over the last 9 quarters, Lulu has met or exceeded their guidance except for one time, and that was Q3 2022 when they missed on revenue and earnings per share both. Now, there were 2 other quarters where they missed earnings per share guidance on a GAAP basis, but they met it on an adjusted basis, which accounts for one-time charges, acquisitions, and that type of thing. But still, overall, they had a really good track record, and not only have they met or exceeded guidance, but every quarter for the last 9, they've increased their full-year guidance. And up until this most recent quarter, they increased revenue and earnings per share guidance for the year every quarter. Now, this past quarter, they kept their revenue guidance for the year the same, but they still increased their earnings per share guidance. So what does this actually tell me? Now, obviously, it's not a perfect science, but I do this type of research to see how well the management team does what it says it's going to do. And based on the last 2 years of history, Lulu has an almost perfect track record. So I take that as a management team that understands their business and how to anticipate their performance, as well as having a history of underpromising and over-delivering, which in general is what you want out of a company as an investor. And just to bring this point home, the reason I do this is because it gives me that much more confidence in saying, okay, Lulu's telling me they're going to have mid-double-digit earnings per share growth and 10% revenue growth. But these analysts out here are saying that they're losing market share and the stock price is down a lot. Well, I can assume Lulu's outlook is closer to the truth because I have 9 quarters of previous history that tells me it's a pretty good bet that they're going to meet or exceed their guidance. Or I can believe the analyst and how many commenters online are talking about how Lulu's done. And when you look at it like that, it seems pretty obvious because remember, stock picking is all about probabilities. Like we're doing research to find an edge to increase the probability that a company will do well. So when I see that they've hit on 8 of their last 9 quarters, I feel pretty good about it, especially with all of the rest of their fundamentals being true as well. Now, hopefully that all made some sense and I didn't bore you too much, but that's how I approach aspects to this research to try to sift through all the noise and headlines and try to get some info that helps me actually predict these probabilities. All right, so at this point, we have a pretty good idea of what Lulu's earnings were about, but let's talk about their growth outlook because ultimately an investment in Lulu is an investment in their growth story. Now, we know that as of this last quarter, revenue was up 10% and earnings per share was up 11%, but those numbers don't really explain the full picture, so we need to go a level deeper. Now, Lulu splits their revenue numbers 2 different ways, by product type and by geography. So let's talk about product type first because that's going to be a slightly shorter conversation. So as we can see for Q1, women's products are about 65% of their revenue, men's are about 23%, and accessories or other is about 12%. And there's a couple reasons why this is important. Now, first of all, a lot of people's opinions about Lululemon is that they're literally just a leggings company. Now, obviously, they innovated and created that category, and it's a huge part of their business, but it's clearly not the only part, with men's, which obviously has nothing to do with leggings, being almost a quarter of their business by itself. And the men's category has been growing steadily over the past year, with 15% or higher growth each quarter for the past 5 quarters, which is pretty good. Accessories is 12% of their revenue and really shot up last year as their bags, backpacks, and pouches became very popular. Now, accessories was only up 2% this past quarter, so it may be something to watch going forward. But in terms of women's, there's been good growth in that category as well, with double-digit increases each quarter for the past 5 quarters. So when you look at Lulu's product mix overall, the growth story is there, and it's a pretty good one. You could argue that accessories may be something to watch, but I would consider that the least important of the 3 and something that's probably more prone to fluctuation anyway. But where the conversation gets a little bit more interesting to me is the breakdown by geography. US and Canada make up 73% of their current revenue. China is about 16%, and the rest of the world is about 11%. But if you look at the growth rates of the regions, there's an obvious story that's playing out. So clearly, you see that international is a huge part of their growth story. But let's take a look at what it was a year ago. In Q1 of 2023, US and Canada made up 78% of their revenue, China about 13%, and everywhere else about 9%. So what does this information tell us? Well, first, it does seem like growth in the US and Canada is slowing down. And Lulu talked about this in their earnings call, saying they had some missed opportunities in women's and bags, which they're addressing. So it's going to be curious to see what happens with that as the year goes on. Second, international growth has been a really great story so far, especially in China. While other companies are seemingly struggling there, Lulu seems to be striving. Now, the growth rates in China and the rest of the world did slow down a bit in Q1 from the previous quarter, but I don't think you can view a 28% growth rate as anything but positive. And I think the other part to remember is that everyone was saying how this company was done basically and that they would struggle with the economy being what it is and consumers not wanting to spend on expensive leggings. But instead, they're still reporting double-digit revenue growth for the quarter as economic factors were more challenging than they've been in the past. So while the earnings report wasn't some huge beat, it was a solid continuation of Lulu's existing growth story in a time when consumer health is a bit of a question mark. And I think the market realized that simply contradicted all the negative news that had pushed the stock down a little bit too far. And they talked about that a little bit here.
All of that being true, if the stock trades tomorrow where it's trading right now in overtime, it'll be about where it was 3 weeks ago, which is still massively down from where it was in February. What do you have to believe about the rest of the year, about Lululemon, to think that this is a great place to buy it?
I think you have to believe that there's going to be an acceleration in top line growth, that you're going to have a stabilization in North America and continued growth in international. And I think you have to believe that the gross margin, that there's still going to be upside on the gross margin because you have a strong balance sheet, but the continuation of positive beats is an encouraging sign. And this is your first marker that they did it, frankly, in an environment that I've termed a squishy consumer environment. So they've been able to deliver better than expected numbers, both on the gross margin and also on the operating margin with clean inventory.
So overall, I thought Lulu's earnings were good, and all the reasons why I added them to my portfolio in the first place are still there. Because they're a company with a revenue growth outlook of double digits, with strong international growth prospects and a plan to address slowing North American sales. And while people may say that depending on growth in China is a risk, I mean, sure, maybe, but it's also the second largest economy by GDP in the world, and Lulu's a company that seems to be doing very well there at a time when other North American companies are struggling. Their earnings per share growth outlook is over 15%, and they have a strong history of meeting and exceeding their own guidance. They still have zero net debt and trading at a price to cash flow around 17, which is very attractive given their own history. So as we go into their next earnings call, a couple of things I'll be watching are US and Canada sales growing at a faster rate now? Is international growth, especially in China, maintaining its 20% growth rate? And is the growth in men's and accessories continuing to broaden the weight of their revenue categories? Now, just real quick, I wanted to point something out because I gave Jefferies analyst Randall Koenig a bit of a hard time in my last video because I thought some of his Lulu analysis was just kind of weird. But I have to give him credit about one thing because fair is fair. He was quoted as saying he was unimpressed with the color assortment, which I thought was just a weirdly specific criticism. But then in the Lulu earnings call, CEO Calvin McDonald said, quote, "When looking at women's, we did not maximize the business in the U.S., which was the result of several missed opportunities, including a color palette in our core assortment, particularly in leggings that was too narrow. Where we had color, guests responded well. We just needed more as they're looking for additional choices." So, Randall, we disagree on Lulu overall, but I have to give you credit where credit is due. You nailed that one. So what did you all think of Lulu's earnings? Did anything actually surprise you? Let me know down in the comments below. Now, if you want to watch my original analysis on Lulu when I added it to my portfolio, it was part of my video about Amazon's shareholder letter, which you can watch by clicking this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you in the next one. Peace.